Ever feel like you're just one step behind the market? You see a big move happening, but by the time your indicators confirm it, the best part is already over. It's frustrating, right? Well, if that sounds familiar, you're in the right place. Today, we're going to pull back the curtain on the exponential moving average, or EMA. It's a tool built for speed, and we're going to break down exactly how you can use it. Let's get into it. Okay, so let's just dive right in. When you hear those three letters, EMA, what's the first thing that pops into your head? Because, depending on who you ask, you might get some pretty different answers.
For some, it might be a European health agency. And yeah, the European Medicines Agency is a huge deal. They're responsible for the safety of medicines for about 450 million people. Super important work. But nope, that's not the EMA we're here to talk about.
What about an IT research firm? If you're in the tech world, you might think of Enterprise Management Associates. They're the pros who guide companies through all the complicated stuff like cloud computing and cybersecurity. Again, critical work. But that's not our EMA either.
Or, is it a powerful trading indicator? Ding, ding, ding. That's the one we're after. The exponential moving average. It's a foundational tool for any trader trying to cut through the market noise and see what an asset's momentum is really doing. This is the one that helps you make sense of the charts.
So why all the fuss? What makes this particular indicator so essential? Well, I want you to think of the EMA as your own personal financial compass. Seriously, its entire job is to help you navigate the choppy, often stormy waters of the market and find your true north.
And this quote from investing.com just nails it. By the time a traditional signal confirms a move, the best part of the trade has already passed you by. We've all been there. You wait for the signal, it finally shows up, and you've missed the boat. That exact feeling of being late to the party is the problem the EMA was built to solve. It's all about speed.
So, let's get down to brass tacks. What is it? The EMA is basically a line on your chart that smooths out all the jagged price action to show you the real trend. But here's its secret sauce. It gives way more weight and importance to what's happening right now. It cares a lot more about yesterday's price than the price from 3 weeks ago. And that focus on recent action is its superpower. And this is where you really see its power, especially when you compare it to its older, slower cousin, the simple moving average, or SMA. See, the SMA treats all data equally. A price from 20 days ago matters just as much as yesterday's price. But the EMA, it's like a news bulletin. It's obsessed with the latest information, which makes it way more nimble and quick to react when the market suddenly changes direction.
Now, don't worry, you don't need to be a math genius to use this, but it's kind of cool to know why it works. Deep inside the EMA's formula, there's a special smoothing factor. And that little ingredient is what tells the indicator, hey, pay extra close attention to the newest prices. That's the engine under the hood that makes the EMA line pivot and react so much faster.
All right, enough theory. We get it. The EMA is faster. But how do we actually use it to make trading decisions? Let's open up the playbook and look at the core strategies that traders use every single day.
First things first, you have to choose your settings, and that really depends on your trading style. The 12 and 26-day EMAs are perfect for short-term moves. In fact, they're the building blocks of the famous MACD indicator. The 50-day EMA is kind of the classic benchmark for the medium-term trend. And then you have the big one, the 200-day EMA. This is what many traders call the line in the sand. Big institutional investors watch this one like a hawk to judge the overall health of the market.
The first strategy is one of the most popular, using the EMA as a moving or dynamic area of support and resistance. Picture this. In a strong uptrend, you'll often see the price pull back to the EMA, tap it like a trampoline, and then bounce higher. That little test of the EMA can be a great place to look for an entry. And of course, the opposite is true in a downtrend, where the EMA acts like a ceiling the price just can't seem to break through.
And now for what might be the most famous technical signal of all time, the crossover. It's simple. You put two EMAs on your chart, a fast one and a slow one. When that faster line crosses above the slower one, that's called a golden cross, and it's seen as a powerful bullish signal. But when the fast line dives below the slow one, that's a death cross, and it's a major warning sign. Now, a little pro tip. These are often late signals, but they are incredibly useful for confirming that a major trend change is probably underway.
So let's see what this looks like on an actual chart. See on the left side, in that strong uptrend, the EMA lines are all fanned out, perfectly ordered, like lanes on a highway. That's a sign of powerful, healthy momentum. But then look over to the right, where they start to get all tangled up and cross over each other. That's a visual cue that the trend is getting weak or just chopping sideways. It's that kind of clarity that makes the EMA so powerful.
Okay,
Time for some real talk. No single indicator is a magic bullet, and anyone who tells you otherwise is selling something. To use the EMA like a pro, we have to understand its weaknesses and pair it with smart risk management.
So, here's the million-dollar question. Is the EMA foolproof? Can we just trade every single signal it gives us and expect to make money? The honest answer is absolutely not. No way.
The EMA really has two main limitations. First, always remember it's a lagging indicator. It follows price, it doesn't predict it. Second, its greatest strength, its speed, can also be its greatest weakness. In a choppy market that's just going sideways, that sensitivity can cause whipsaws. It'll give you a buy signal right before the price drops, or a sell signal just before it rips higher. It can drive you crazy if you're not careful.
So how do we deal with that? Here are 4 pro tips. First, always seek confirmation. Never trade an EMA signal alone. See if another indicator like the RSI or MACD is telling you the same story. Second, look for confluence. That's just a fancy word for when multiple things line up. Does your EMA signal happen at a key support level? That's a much stronger setup. Third, filter out the noise. Wait for a price candle to actually close above or below the EMA. Don't just act when it touches it. And finally, the most important rule of all, always use a stop loss to protect your capital. Every single trade, period.
So let's bring it all home. The exponential moving average is a dynamic, responsive tool built to solve one key problem: lag. It gives you a faster, cleaner way to identify and follow the underlying trend, cutting through all that daily noise to give you clear, actionable signals. By understanding how to set it up, how to read its signals, and how to combine it with solid risk management, you can make the EMA a core part of your trading toolkit. The compass is now in your hands. The only question is, where will you navigate next?